What's up, YouTube? Today we're going to be talking about bonds and all about the world of bonds in this guide, so you have a little idea of how the world of bonds works, and so you can make better educated decisions as an investor. So what is a bond? A bond is just another name for a loan, essentially. You are lending money out to somebody or an organization, and you're expecting to have your principal paid back, and in the meantime you're going to be collecting interest payments or coupon payments. So who are the organizations that might want to issue bonds or have money lent to them? Well, there's four categories, or four main categories, that I'm going to focus in on this video. There's more, but the four are: number one, the US government. That's right, the US, they're always issuing debt. So that's why we always have the debt clock that's going up and up and up and up and up. You can buy the US government's debt, and so you then become a little owner of the US government. And so they are going to pay you your principal back in the future plus your interest. The US government has also never defaulted. They've gotten really close, but they haven't. And now that's also where the idea is, when you hear other countries owning the US government, that's what happens. They buy the US government debt and they become a little bit of an owner. Conversely, we can buy other countries' debt and then we own their country. And there may be reasons beyond, ultimate world domination to buy another country's debt. Maybe they're not as strong of a country and therefore they pay more interest. Number two, municipalities. So little cities, or cities in general, they want to grow, right? They want to grow infrastructure and they need some way to finance that. So that is where bonds come in. Let's say a municipality says, hey, we want to put in a new toll road. They then go out, they issue a bond, they get that money, and then they build the toll road. Number three, mortgage-backed securities. So what this is kind of a unique scenario where banks, they issue mortgages, and then they package all that together, and then they then go out and have that packaged by Fannie Mae and Freddie Mac, and then that goes out and becomes bonds. And so what that does is it makes the flow of mortgages try to be a little more seamless. That's the idea. So number four is corporations. So Apple, Google, Pfizer, Microsoft, Tesla, they all need big amounts of money to fund their operations. Apple doesn't go to local Chase branch and say, hey, can I have $500 million? No way, right? So they then say, we are going to issue a bond, and that is where they raise their money. Now, as you're thinking about these different organizations, what sticks out is different companies may not pay their money back. That's where creditworthiness comes in. And that's where there's different rating agencies that say, hey, we're going to evaluate and say, what is the creditworthiness of a company to pay its money back? Now, that ranking system is typically at the very top. AAA is the absolute best. That means like you're never going to default. And at the very bottom is D. And if you go from D and you go to double B, that section is what's called non-investment grade, high yield, junk bond. It's all the same. Now, does that mean people don't buy that debt? Definitely not the case. People buy that debt all the time. They buy those bonds all the time, but they just expect a higher return. Above that, where the cutoff line is triple B and above, that's what's called investment grade bonds. Now, do bonds fluctuate in price, you might ask? Well, they definitely do. And they don't in the way of how you may think, because if you lend somebody money or you buy a bond and you buy one individual bond and it matures in 10 years and you hold it for 10 years, your only risk is whether it defaults, right? The other risk is, as you collect those interest payments, what are you reinvesting them into other bonds? At what interest rate are those other bonds paying you? Well, that's reinvestment risk. Now, If you wanted to sell your bond though in 5 years, well, what is it worth? Different bonds are paying different rates. Well, that's where there's two big factors that affect the pricing of bonds when you resell them in the secondary market. Number one is interest rates, and number two is the credit risk. So interest rates, or the risk of interest rate sensitivity, is measured by the concept of modified duration. There are other different types of duration measures, but for this video, I'm only going to talk about modified duration as it's a really, really popular metric. What it measures is how your bond price moves in relation to interest rates. So if interest rates go up 1% and you have a modified duration of 5, that means as interest rates move up 1%, your bond is going to go down 5% in value, or your bond portfolio is going to go down 5% in value. Now, the other thing is the creditworthiness, and that's what we call credit spreads. So if you invest in something risky, it might not be very desirable when we're in an economic recession. Now, as the economy improves, and now we're in this great economy, someone might be willing to take on that risky bond because it's unlikely that the company might default when we're in a better economic environment. And so that's where we have credit spreads narrowing and widening. And so when credit spreads narrow and you have something that's risky, the value of your risky bond goes up, and vice versa. Now, those concepts apply to an individual bond, and they also apply to a basket of bonds. And that's how most people usually invest. Most people don't buy one individual bond because they want to diversify their risk, number one, and number two, it's typically hard to buy individual bonds because it requires a lot of money to do. So what people do alternatively is they buy a mutual fund or an ETF that owns thousands of bonds, and then they're able to diversify their risk, and that is how they can diversify out at a low cost. So the interest rate sensitivity and the credit rate sensitivity affect that overall basket of securities and what it's worth. The reason why you never get paid back your principal when you own an ETF or a mutual fund is because those instruments are usually buying more bonds. So they're constantly, as the bonds are maturing, they're buying more bonds. Bonds mature, they buy more bonds. And so they keep the cycle moving. And so that's why the value is fluctuating, because you're looking at the aggregate and you're not looking at one individual bond. If you owned one individual bond and it matured in 10 years, and if you held it for 10 years and they didn't default, you would get your money back and you would get all those interest payments. But most investors, they own the basket. The other thing I want to touch on is why bonds tend to be less risky than stocks. The first obvious reason is because bonds have a contract of saying, hey, we're going to pay an interest rate, right? So when you get a mortgage, you have to pay that mortgage payment every month with the principal plus interest. So when you buy a bond, you're going to collect that interest payment regularly. When you're a common stockholder, company doesn't have to pay a dividend, and usually those are less frequent. The other big reason is because where it is in the capital stack. So if you own Apple's common stock and you own Apple's bonds, if Apple goes, under and they completely go bankrupt, well, they are only going to have so much money to pay everyone back. The first person that doesn't get paid back if they don't have enough money is the common stockholder or the owner of the company. Then it goes up different tranches. So bondholders are senior, or they are more likely to be paid back than common stockholders. So when an organization goes bankrupt, there's more security in owning a bond than there is a stock. So I hope you like this video and a little glimpse into the world of bonds. Thank you so much for watching.